So, good morning. I listened very carefully. I found it extremely interesting, and I was struck by some of the comments you made, Andrea, especially when you said that banks are depending increasingly of governments in terms of ownership and also in terms of exposure. And I wanted to add to you comment also in terms of funding, in terms of liquidity provision from central banks, which I think is one of the things you could have added in your comment. But it's I found it also, and on Basel, I think also I was struck also by one of the comments you made, Andrea, on the LCR, the liquidity reference, which surprised me because that's a little bit a different tone we hear from the banking sector about the pro-cyclicality of some of the elements of the new Basel concept. But I found it very stimulated, and I'm very grateful for the invitation, really, in this very prestigious university. I'm very honored. I don't say that usually when I'm invited, but I'm really honored to be here. It's not the first time, and I always extremely enjoy the intellectual climate of this institution in particular. So many thanks for this invitation. I try to be up to the task, and as you know, as a central banker, I'm invited usually to stick to a prepared text, so I will try to make it not too boring and to try to convey some of the key issues that central bankers have in this very difficult deleveraging process that we see in the financial industry in Europe. I think that's the main theme of my speech. So the banking sector deleveraging process in the euro area has been underway since 2008, actually. You stressed 2010, of course, where things accelerated on the downside. But actually it started, as you know, in 2008, so more than 5 years. And then I would say that until recently, most of the adjustment has been achieved by increasing capital via equity issuance, conversions of hybrids, capital injections, and retained earnings. But with the intensification of the sovereign debt crisis, and that's what you stressed, there has been stronger pressure to also adjust via asset shedding, and especially those assets with higher risk weights or denominated in non-euro area currencies. We have seen a very strong, actually, deleveraging of in the non-euro currency market, which led the central bank to provide the cheaper conditions, dollar funding especially, via the swap arrangements we have with the Fed. Now, the deleveraging process is necessary, but as we know, it bears the risk of becoming abrupt, disorderly, and is threatening the provision of credit to the non-financial sector. And as a consequence, that's our responsibility, what we call the transmission mechanism of the monetary policy. So that's the sort of balance sheet transmission channel. So in my remark, I will highlight the challenges for the central bank, the ECB in particular, in dealing with this process of deleveraging, and also stressing the measures that we have taken in recent years. And I will go back up to 2008, but very briefly, and explain how they helped to prevent self-enforcing spirals, and that could have been very destructive for the whole economy. But still, as we know, the conditions remain very difficult in spite of huge increase of the balance sheet of the central bank, as you know. So let me start from the beginning and the banking sector deleveraging in very, I hope, very simple terms first. And I just put it in the background, I put, just for illustration, I mean, this table about leverage ratio, a simple leverage ratio in 2008 of the large complex banking groups, European, and then euro area on the right side. You see the leverage ratio 2008, 2011, 2012, first semester, and then the change in equity that you have since 2008. So to illustrate a little bit that something is going on, these figures are very difficult to interpret, and I don't want to go into the technicalities of that because I see, for example, in some countries the balance sheet is increasing for mysterious reason for non-informed persons at the time of deleveraging. Italy would be one of the causes. I'm not going to address that here, but be careful about the figures, but the phenomenon is absolutely clearly going on. Now, banks can take different combinations of actions, we know that. They can act on the asset side, on the liability side. On the asset side, of course, you have the asset shedding. You have the rationing of lending. You have on the liability side, of course, capital increase, returned earnings, conversions of hybrids, etc., etc. What you also have seen very much in the strategy of deleveraging of banks is the funding side, where the banks, before going, increasingly to the central bank, the banks started to increase the secured part of the funding of their balance sheet, the secured part, because the unsecured was, of course, impaired very much. But by doing this move from unsecured to secured, you reduce, of course, the pledgeable assets that would remain for the unsecured lenders to the banks, which is at some point the secured lending becomes also a problem because the unsecured might be more difficult the more you do that. So which is one of the things. But when you look at the whole adjustment of the balance sheet of the banking sector since the August 2008 when the crisis really started, the adjustment, as I said, is a combination of actions. The problem on the asset side, that's why we look very much on the asset side, the adjustment on the asset side of the balance sheet can lead really to a credit crunch if they are made by many banks simultaneously. And we know that now from a very vast literature, academic literature, where the rational behavior at the level of individual banks can impose externalities, negative externalities on other players in the financial system through fire sales of assets and financial contagions, which is one of the channels, as we know, a negative externality. And this can set a self-sustained process in motion that ultimately can bring the whole financial system to collapse. If you push, in model terms, you push that phenomenon and you don't stop it, it can have far-reaching consequences on the financial system as a whole. So my next point here from that very simple observation that we know is that the mix of actions on the asset side and the liability side of banks is not necessarily optimal from a welfare point of view. We know that. For instance, and I want to stress that, the reluctance in some banks to issue equity and dilute the value of their shares may lead the banks to privilege, for example, asset shedding than capital increases. And we have known that because the decision-making process, the governance setting of a banking institution may privilege some forms than other forms. And so there is a risk, there is a role for authorities in trying to steer the process towards certain courses of action in which banks' choices are better aligned with economic welfare. So I think it's very important. I think everybody would agree, also private sector, because the private sector managers are also themselves in their own rationality, of course, and it's very difficult to take into account in a private sector decision-making process these externalities. And we know that regulation tries to internalize these externalities via regulation. It's not easy to do, and we understand all that. But the fact is that there is a role for authorities. But from that point, I immediately want to add that authorities themselves also face constraints. It's important to realize, not talking about, market failures versus government failures, but there are also constraints. And basically, there are two sets of constraints, and it's very important for the future to think about that. The first is some of these constraints may relate to institutional weaknesses, where, very simply, the supervisor lacks specific powers to enforce resolution. I mean, that's typically in the euro area. We don't have a European resolution authority. And even within the national frameworks, some of them in some countries are weak in terms of powers to organize the resolution process of a failing institution. Another issue which is much more difficult even because, again, this is very well known and taken on board, and there are reactions at the policy level, at the European level on this. We'll see, we can discuss that. But there is another issue also in the enforcement of all that, in the role of authorities, is the incentive problem that you also find in supervisors. For different reasons, supervisors may have incentive problems that can lead to delayed action, that can be lack of will, that is being called in the literature as gambling for resurrection, because when a bank is in difficulties, it also reflects, probably, I mean, very often it could reflect failing supervision. And so the supervisor may have a natural instinct to try to buy time and to hope that the things are going to go better later on. So the incentive issue that I mentioned for the private sector, we find also incentive issues at the public sector, and that's why me personally, I'm very much, and I see some of my friends also from the Basel Committee, very much to set some preset rules in terms of actions that authorities have to take in case an institution runs into difficulties. We call it in the US prompt corrective action, but we need to go into these sorts of mechanisms that would be better to defend public good. So, as I say, in this context, Europe faces specific challenges given the lack of harmonization of national systems, which strongly, and in my speaking notes I put, quote, complicates the resolution of cross-border banks. That's the least one can say. We know we are still extremely weak in dealing with that. Significant steps, however, are being taken to overcome these shortcomings, and that will be for the end of my speech. I will return this later to that. So that's the setting. So there's a big deleveraging. There is a little bit this question about asset side shedding or capital increases. So and I say that in the beginning there was a lot of capital increases globally, as you see. But more recently with the sovereign debt crisis, we have seen more asset shedding, and with the risk of negative externalities creating spirals. That's a bit the first message. The second, of course, if you look at the role of central banks and monetary policy in the deleveraging process, as you know, central banks can provide liquidity, of course, which is the basic story here behind that. So the deleveraging process in the banking sector is a necessary process to correct the imbalances built up prior to the crisis and to bring the economy back to strong and sustainable growth path. But disorderly deleveraging can represent a serious threat to price stability. Of course, if we think about this, you know, this sort of spiral that you can have with the way the banks adjust to the deleveraging pressures, if that process goes to its end, you get downwards pressure on price stability, downward pressure, of course, via the credit channel, basically. So the financial sector, as we know, represents a powerful conduit of the monetary policy impulses decided by the central bank. And so we call it, as I said, the credit channel. The transmission of shocks hitting financial institutions' balance sheets to the real economy, or shocks originating within the financial system itself, is exceptionally strong if banks are not able to shield credit supply, and if borrowers are highly dependent on bank credit to finance investment and consumption. Many euro area banks, for instance, have been highly dependent on market funding and have therefore been vulnerable to sudden stop in this source of funding. We have seen that in many places, especially as you know, there have been, since the start of the monetary union in Europe, a lot of increases of current account imbalances, which were financed by wholesale markets, of course. And as you know, wholesale markets can dry up very rapidly in case of fear of counterparty risk and create also this sort of funding problem at system-wide level, which is actually what happened in recent years in the Eurozone. So we know also that if these things happen, the sudden stops in the source of funding is extremely, of course, grave from a monetary point of view, because your area banks are the main providers of funds to the non-financial system. We should not forget in all that discussion that we are still today a highly bank-intermediated financial system. So when you have shock in the intermediaries, it has, of course, potentially grave consequences on the whole financial sector, the financial economy, I mean, and the provision of funding to the non-financial firms. In such a situation, the transmission mechanism of standard monetary policy impulses may become impaired, and the central bank has to resort to non-standard measures. I mean, you know the mechanism by which the central bank intervenes to steer, you know, pricing, the risk-free rate, basically, by open market operation. We basically, in Europe, do it via open market, via repo operations, contrary to the US, where you have more direct open market operation than we do. We do with repo, basically. But what is key to understand, whatever the intervention tool that you follow, what is key to understand is then when you get that sort of impairment in the functioning of the banking industry, you have to deal, of course, with a number of rationing mechanisms and not with pricing mechanisms. And that's really what happens in the system. So during the financial crisis, and especially the banking crisis, I think it's important to realize that we have more a banking crisis. The bank's demand for central bank liquidity may sharply increase to compensate for the decline in other forms of bank liabilities, often resulting from withdrawals of bank deposits. It was essentially wholesale deposits that dried up. So you have basically a very simple thing when you have to explain that. You see, well, there is a demand for the demand for commercial bank money goes down, and the demand for fiat money, the central bank money, goes up. There is a sort of substitution there. And then comes the question of the central bank: do you compensate that switch of preference for money from commercial bank money to central bank money? Do you accommodate it? To what extent do you then? And at what speed, against what conditions, etc. From a pure monetarist orthodox point of view, I explained that in another speech, from a pure one, you would look at the liability of the central bank, basically, the liability side of the whole aggregated liability side of the financial sector, so you would look at money basically. Because you say there is a substitution, do you accommodate? Then your money supply will not be hit because there is just a substitution, or you let it go more. So that would be basically the focus of what you would do as sort of in pure monetarist orthodoxy. Now the asset side is quite important on the balance sheet. It's not in my notes, but the asset side on the balance sheet is quite important because what sort of assets are you going to take? What sort of conditions are you going to impose on the asset side? And it's very important to realize that even if you get it right on the right side, so you look at the money supply in view of inflation or price stability in the long term or in the medium term, if you do it that part, you have to see on the asset side for different reasons. But one of the reasons is, of course, the conditions which you are applying on the asset side, so the sort of assets you take, the conditions you give, influence, of course, the whole incentive scheme. And then you have to find the right balance, of course, that, for example, if you buy massively government debt, to what extent do you change the incentive, to manage public debt in view of long-term of solvency or debt sustainability, you see. So the asset side really matters also, and we have been struggling also with, not only by looking at money supply in pure monetarist orthodoxy, but the way, the conditions on which you supply that liquidity. And then I will explain a little bit on that. So the first point was this, that during a financial crisis, banking crisis, the demand for central bank liquidity sharply increases. And the central bank has to accommodate, and I said to what extent, such an increase in the demand for liquidity. Because the central bank is the only agent able to prevent a process of disorderly money supply contraction. And I give you very simply here the graphs of M3. We published the figure of M3, I think it was yesterday, or the day, I got it before, so I never know, I think it was yesterday, or the day before. And so you have basically the blue line on the red, that's M3, or definition M3. You see there was some down now. I think it was 2.6 now, the figure. We came out. The red line is not for now, it's the credit side, which is very, you see the disconnection, by the way, between the money supply, which is weak, of course, but the credit side, which decouples from the money. It's relatively rare if you look historically, and if you go even before the period that you see here, it's relatively rare. You see basically a search for demand for liquidity from economic agents in general, and on the asset side, there is not much demand for loans. So there is a lot of hoarding of liquidity in the system when you simply look at that sort of graph. But we look for our sort of price stability barometer. We look at money supply, which also is weak, but of course not as weak as the credit side. Now, you see on the right side, you see the base money, of course, as you know, has surged. And especially, as you said, especially after the LTRO, the supply of liquidity that was the response to very big funding tensions in the banking system around the end of 2011. And you see the very big surge of liquidity following that period. And you can put it also in other terms. You can just look at the multiplier, which is just the ratio between the two ones. And you see the multiplier of base money, I mean, as defined, you know, M3 divided by base money. You go from, let's say, 10, 12 to something like a bit below 6 today in terms of multiplier. So the question is here that you have a reaction function of the central bank. It accommodates this huge surge of demand for central bank money against commercial bank money. So the central bank can use the amounts and modalities, as I said, of its liquidity provision to the banking sector to influence prices in the money markets and other markets for relevant assets. By easing the pressure to abruptly deleveraging, the central bank can reduce the likelihood of a credit crunch and adverse spiraling dynamics, thereby addressing downside risks to price stability. And I will tell you, since 2007 already, we were faced several times with that risk, and unfortunately, increasingly with that sort of risk. And we responded. It should be kept in mind, however, and this is the caveat I said when we look at the asset side also of the balance sheet, how do you do that? How do you distribute that liquidity that you create to keep your price stability objective in the medium term, as is our mandate? So how do you do that on the asset side? I just come with my caveat here. It should be kept in mind, however, that monetary policy can exert mitigating effects, but cannot solve the underlying problems, often of a structural nature. In addition, the creation of abundant liquidity, central bank liquidity, can itself create side effects that needs to be, as we usually say, carefully monitored. We have to be careful about these side effects. First, there is a risk of distorting the incentives to carry out the necessary adjustment, if you are too generous in the supply of liquidity and in the conditions under which you supply that liquidity, by favoring evergreening of loans and what we call zombie bank type dynamics. Make it too easy, the deleveraging process, or the recap, whatever the thing, is too slow. So that's the balance you have to find. And here we talk about things like moral hazard versus the other risk, which is the risk of a severe process that could lead to money supply contraction. So you have to find the right balance in looking at the two extremes, the two risks. One is the risk of a self-fulfilling, an adverse spiraling dynamics, and the other would be the incentive problem, which is related to moral hazard and the incentive to adjust. So this will represent a continued source of uncertainty about banks' exposures to non-performing loans, because the adjustment process is too low. So uncertainty is kept alive in the markets about the possible implicit liabilities faced by governments and ultimately a drag to economic growth. Of course, if the adjustment doesn't happen, it will also feed back on governments as a sort of backstop to the financial system, and then you get this loop also. I just wanted to stress this loop also. The second is that large liquidity providing repo operation, as we do typically, increase asset encumbrance in the banking sector, just because you pledge to the central bank this time. With the secured funding will come with the central bank this time. Banks will type certain types of collateral with the central bank, and thus these assets are no longer available for banks for other types of transaction. We say it doesn't really matter, but to some extent it matters if the velocity of collateral, I mean it's more technical, but if the velocity of collateral on the private market is higher than the velocity of collateral on the central bank. Obviously the central bank, you get the collateral, it's just stuck in the central bank. In the private sector, as you know, collateral is lent and relent, and can be even relent and relent. So the velocity of collateral also is different when you shift from one to the other. It's a technical remark, but this is quite discussed now in financial circles. A second issue is also that if you pledge a lot of collateral, as I said before, be it in the private sector or in the public sector, in the central bank, you may have more, as a bank, difficulties to issue unsecured bonds, and this could worsen your access to private sources of refinancing. That's a remark I made just before. So when we go backwards, for the intervention of the ECB since 2007, so more than 5 years now, I just wanted to stress the August 2007 measures, and I remember, you remember, we had this stress, we know, I'm not going to elaborate on this, there is a little bit more in the notes. But the provision, I just say, was a little bit lesser than 100 billion. At that time, we knew exactly. I just forget. I think it was 98 billion, Philip. I think it was 98 billion, or 8, I think, billion of euros. I say about 100. Because now, since I joined the central bank a bit more than a year ago, it's 1.2 trillion, I think, that the balance sheet has increased. At that time, when the crisis came, the 100 billion was considered as something very exceptional from the central bank, a very timely reaction to an exceptional shock, liquidity shock in the system, related to a lot of problems of asymmetry of information. The size of the problem was considered as relatively moderate, as relatively contained, but since nobody knew exactly where the risks were, all the banks were suspects, and so that created a lot of stress on the funding side of many banks, and so the central bank reacted by really easing the pressure to abrupt deleveraging, but with a relatively small amount of money, about 100 billion, and that calmed very much the market when the crisis in August emerged. And now, however, so this first year of the crisis, I want to say that there was, and perhaps lesser than in the US, there was not this perception that we were starting a very difficult process of adjustment in the financial industry. It was considered basically to come from the outside, from the US. It was linked to, you know, a sort of technology in the industry, and that the rest of the financial system was really really outside of these developments. And say typically Italy, for example, I remember, because I lived all these episodes from very close, there was a perception that the banking sector in Italy was maybe not the most innovative, but was a sort of sound, traditional, commercial banking activity, having jumped, you know, all these crazy innovations and all that. Now, of course, we know later there was a weak link, which was the exposure and the link with the sovereign, of course, and as a consequence to the possibility of a weaker economy, structurally weak, which would impair, you know, the loan portfolio and all that, which was things that at that time when the crisis, it was totally out. There was more the countries with innovating banking system, which were the focus of the attention, and not the more, let's say, traditional banking sector, which was considered at that time to be rather safe, and there was sort of source of comfort. And I personally, in the European parliaments, had remember very much from a session when I had, not attacked because I know many of the MPs, and they are asking good questions, I think, but they were comparing me because I was around supervision. I was a macro, but supervisor, and my colleague from the Bank of Spain, and I had to take example from my colleague, you know, to do good supervision and things like that. And now we take all this with a lot of care and modesty, I think, all that. But that was a little bit the framework in 2007. So we dealt with this issue relatively, I think, efficiently, but we didn't see the extent of the problem. After the failure of Lehman Brothers in September 2008, one started to realize, especially the institutional weaknesses of the banking resolution framework, obviously, and the sort of problems in which we could have. We had sort of institutional vacuum. And so at that time, one started to see the extent of the problem. Further measures, what we did in the ECB was basically to use the standard measures as we could. I mean, official interest rates were cut by 325 basis points in a few months, in just a few months, which was quite an innovation in the tradition of the central bank. But more importantly, I think open market operations were conducted as tenders with a fixed rate full allotment, which is still the case today. Fixed rate full allotment. This implied that the ECB no longer controlled the aggregate supply of liquidity to the banking system, but that the aggregated demands by banks, subject to, of course, the constraint of collateral, the collateral constraint, determine total liquidity provision. So as long as the banks have collateral, the supply of base money would be fully given at the MRO rate, the central rate of the central bank, the MRO rate. And as a consequence, the Euro system balance sheet increased, as you have seen. At short-term money market interest rate dropped to levels close to the deposit facility rate. Moreover, the ECB further widened the set of eligible collateral. I mean, in the ECB, in the Euro system, you should know, contrary to other central banks, we not only have many counterparties, so there are many counterparties in our monetary operation, which in the August 2007 helped us very much, because some smaller banks having some exposures to complex products could come for liquidity provision. So we didn't have to innovate. Our framework was sufficiently flexible. And a second aspect of our framework is that banks post huge amounts of collateral with the central bank. So they can mobilize these collaterals to get liquidity very quickly. And they did, unfortunately, increasingly over the crisis. And then it proved to be insufficient for some parts of the banking system. So the ECB widened the set of eligible collateral. And finally, and importantly, the ECB introduced a limited number of open market operations with maturities of 1 year at that time. And we conducted 3 such operations in 2009. So because of the maturity transformation of banks, they bought very short, especially on capital markets, and they lent longer term on the other side. The wholesale funding disappeared in some places of the system, and central bank provided increasing term funding to the banks. And as you know, in December, we announced the provision of liquidity up to 3 years, and that proved, I would say, I think personally, a very successful, indispensable operation. The objectives of the second wave of measures is basically at that time when we realized the systemic aspect of the problem, and okay, so that was the story at that time. Let me see what I have here. Yes, here I start with the next wave, which Andrea you addressed, is the tensions, increasing tensions in sovereign debt markets since 2010. We had this very big recession in 2009, which fragilized very much sovereign debts, which were before the crisis also already very fragile. And so the situation of the euro area financial sector worsened. Doubts about the sustainability of sovereign debt levels in some countries led to significantly increased levels of sovereign bond spreads. And this in turn also led to higher interest rates in the private debt markets of the affected countries. It became apparent that the health of the national banking sector was often closely intertwined with the health of the local sovereign, as we know. Funding problems in the banking sector and weak fiscal position mutually reinforced each other. That's another negative loop that emerged. And we usually take this simple graph. On the left you get Italy, because I'm here. The second is on the United States. I didn't bring for all the countries. It's interesting also to look at specific countries, but you see a little bit this 45-degree slope on the left and the vertical on the US. That means that you have a lot of idiosyncratic risk within the financial system in the US, in the banks. When you look at the Italian situation, you see over time, you see all these different colors represent different points in time, but you see the sovereign debt basically deteriorates really in line with the banking sector here. And that fits with my remark before that the exposure, the weak points of the Italian banking system, this sort of traditional commercial banking, maybe not the most profitable, a lot of things had to do in terms of cost cutting and all these things, but in terms of financial fragility was considered as okay, but there was a weak link, which was the sovereign, and that you see very clearly. When you go to Spain, for example, the graph is basically that, but you see more idiosyncratic, obviously, risk that you see in the Italian banking system. So for Italy, cutting, improving the public finances of key importance for the financial sector, and is what we call the transmission mechanism of monetary policy and all that. It's a key issue to address, and as you know, is being addressed. Because of that and the consequences of that, because banks' funding problems get worse, you start to see in the euro system an increasing heterogeneity in the financial sector, increasing heterogeneity. We had already before, because some countries or systems were more exposed than others, but when the fiscal crisis really started, you start to see increasing heterogeneity, and it peaked really, it coincided with the speech of Mario Draghi, the 26th of July in London, where these fears start to amplify and led to sort of, we call it redomination fears. It was a sort of fears that led to this fear of breakup of the euro. And so we started to see there increasingly heterogeneity in the Eurozone, and a sort of process, again, a sort of loop that was continuously amplified. We see it also very clearly what happened in, let me shift to that one, a graph that you may not have seen before, which looks at the cumulative monthly flows since December 2011 on the liability sides and on the asset side. So you accumulate what comes in, funding, and what comes out. I mean, in the lending part, the asset side of different banking system, cumulative. In Spain, Italy, France, and Germany. Just for illustration, I'm not going to go in all the details. You can see that in the text which will be distributed. But you see, for example, in Spain, the cumulative outflows on the liability side was minus 300, starting from a position of about minus 100 recourse to the central bank. So this minus 300 that you see here has been compensated by one-for-one by central bank funding here. So you have this compensation. And when you look at the detail in Spain, what is thrown out, you see this light blue, you see a lot of non-resident deposits, but you also domestic non-NFIs, non-financial company deposits, you see. So you see a lot of outflows of deposits, residents and not residents from the financial sector in Spain, compensated by central bank funding one-for-one. Now, the exposure of the euro system is about 400. Is going down now, but it's about 400. And you see on the asset side, you see these losses on the funding compensated by central bank. There's a difference. You have on the asset side also things happening. This is basically the contraction of credit to the private economy, and there you have the purchase of government securities on the asset side. If you say the situation in Italy, which is obviously very different, because here you have a very substantial increase in that period of deposits, residence deposits, but still a very big recourse to central bank liquidity at the aggregate level, of course, and also on the asset side an accumulation of government security. And Andrea, you alluded to the fact that on the asset side you also have you raised the possibility that it was also linked to regulatory, let me say, distortions. Or regulatory reasons. So you see big changes, of course. You see, especially in Germany, the yellow there, you see these are deposits, excess liquidity, which is deposited with the central bank. So there is a really capital balance of payments, issue that we have in this Eurozone, where capital is flown out of some systems and gone in other systems there. And the central bank has played the role of a hub, a sort of central counterparty, providing liquidity against collateral for one part and absorbing the excess liquidity from another part of the system. And that's reflected, as you know, very highly commented, I'm not going to comment it here, by the target imbalances, which is the sort of the accounting part of our balance sheet, is to say what's come in and what's go in terms of in terms of deposits and what we provide in terms of liquidity. And you have the different countries represented in the colors. These parts are the deposits from the German part. So it's very well known, but this is just a reflection of these capital market tensions that we have in the system. And finally, so we came with different operations, as I say, including the LTRO 3 years, trying to mitigate the increased heterogeneity that we have in the financial system. In 2010 also, the securities market program was launched, as you know, aimed at certain important segments of the financial market that were dysfunctional. And of course, all the ambiguity that you have between, what is the support that the central bank gives to potentially to the sovereign? Well, here the central bank has always tried to deal with the functioning of the markets and the consequences on the transmission of its monetary policy via the credit. And as we know, there is a big exposure from the financial sector to the sovereigns and a big loop between the two. And that creates a little bit the sort of ambiguity in the comments that you can see among analysts and in some parts of the public opinions about that. But the objective is very clearly, is really to address the impairment in the transmission mechanism. It is true that the functioning of the sovereign debt has been one of the sources of the impairments. So we had these 3 years, and finally, I alluded to, I'm not going to comment now on this, the ECB has recently announced the details of the outright monetary transaction, what we call the OMT in secondary markets for sovereign bonds, in order to address severe distortions in government bond markets, but which in particular originate in unfounded fears, we say, on the part of investors on the reversibility of the euro. That was really the big signaling which was given by Mario in July of this year, in the summer of this year. Now, the way forward, I think, and I go to the conclusion now, as I mentioned from the beginning, while monetary policy can alleviate deleveraging pressures in crisis times, it cannot address their root causes, obviously. In fact, to tackle the underlying problems, a wide-ranging of policy responses is necessary, and that's quite a challenge, of course, and that's why markets remain so uncertain in general, because it's really a big challenge. And it has to do with public finance, because we have seen the loop there, so these things have to be addressed and are being addressed. There are things of economic competitiveness, because as we know, if the economy doesn't go well, you can go promise with your credit portfolio, and then you get these sort of things, and also the financial sector itself. And for the very rest of the speech, I will be briefly address the very important aspect which made that the central bank had to be so much involved in provision of liquidity, is the institutional framework that governs financial markets in the European Monetary Union. And as I said in the beginning of the speech, the institutional weaknesses that we have amplified the impact of shocks that we went through in recent years. So first, what principles should the institutional architecture be based on in order to be effective in avoiding excessive risk-taking and cross-border fragmentation of banking sectors? And second, how do the ongoing reform efforts towards a financial market union contribute to these aims, basically. And I will be relatively brief, 2 more pages. But I will read them carefully. I think they're important. In answer to the first question, policymakers should be guided by 2 criteria. First, economic actors that stand to gain from risky activity should also bear the associated downside risk. I think we agree. It's difficult to do, but we agree. To be concrete, a system in which banks can expect to be bailed out by taxpayers if their investment decisions go wrong is neither efficient nor fair. So that's one of the principles, and we work on this. So that's called market discipline. Second, the institutional architecture of EMU should achieve a level of integration that is commensurate to the integration of its banking financial sector. Because as you know, we have a single currency, we have open markets, but there is no institution that deals with crisis management and crisis resolution, which is a key question. Hence, there should be no systematic cross-border, cross-country differences in the design and implementation of the rules that governs financial markets. Otherwise, such difference might become a source of financial fragmentation in crisis times, basically. Because what you see today is national supervisors tend, of course, to ring-fence liquidity, to be sure, because the resolution process is basically national, that supervisors tend to retrench behind the national borders. So that fragments liquidity further and increases also the pressure on the central banks to respond to these liquidity pressures. Neither of these criteria is easy to fulfill, and we have seen that with the experience of Lehman Brothers, of course, because we have done a lot since Lehman Brothers, but we still don't have a very solid, operationally effective resolution authority that could deal with such sort of problems. All these difficulties are being addressed by European policymakers. I think that's a very positive aspect. You have to learn from the crisis, you have to respond, but the challenge is very high. In particular, I think the recent initiative at European level comprise several of the crucial steps which are necessary to achieve a more incentive-compatible as well as a more integrated and coherent framework among countries. First step is the establishment of a single supervisory mechanism, what we call the SSM. Yes, the aim is to ensure that all supervisory decisions about euro area banks are taken in a consistent and stringent manner, independently of the country in which it is located. I mean, when I say independently, it responds to a sort of preoccupation that local authorities have been to proximate to the banks in addressing the adjustment process. And there is an idea that you need to have a more system-wide approach, not a national approach in the resolution process. It's a quite difficult thing to do, but I have to reflect carefully about that. Once fully effective, this will reassure markets. That's why we work very much on that. It should reassure markets that all banks face the same scrutiny, and this will counteract financial market fragmentation in the euro area. I come with my fragmentation because the national pool, money goes back to some place and out from other places, creates a big shock in itself. It's not just the portfolio itself, but the funding side where there's this retrenchment process destabilizes very much the system. So we have to respond to that. Delegating supervisory decisions from the country to the euro area level should facilitate the internalization of cross-country spillovers and thus allowing for more efficient outcomes. It is clear that when a national supervisor ring-fences liquidity, for example, it's probably fine for its own environment, but collectively, of course, it creates externalities on other pieces of the system, of course. And we have to deal with that externalities related to authorities' national decision-making. So that's a question for authorities themselves. As a further key element, the European Commission, as you know, recently released a proposal for a bank recovery and resolution directive, which contains important crisis prevention, early intervention, and resolution tool. Again, this toolkit serves to avoid taxpayers' financial bank rescue operations and to harmonize practices across countries. A fully integrated financial framework, as also envisaged under the current reform agenda, would move beyond these common tools by establishing a common resolution framework, including a resolution authority at the Eurozone level. This would further strengthen harmonization and stringency in line with the philosophy underlying the Bank Recovery and Resolution Initiative. I think it's very important to realize today that we are relatively well advanced in political terms in terms of the single supervisory mechanism. In the resolution framework, we have a framework, but in terms of the implementation of that framework, which we discuss now, we have to be careful not to have too much asymmetry between a supervisory authority, where I think the progress would be faster and normally very fast, and when the recovery, the resolution authorities and the framework would be too small, too low, too slow. And because in that case, the supervision authority will have to deal with the national resolution authority. And what is the degree of asymmetry between these two institutional evolution, the single supervisory authority and the resolution authority? What degree of asymmetry can we accept institutionally to make the system working? And here the message we at the central bank give is that we have to speed up very much the resolution part. I think the supervision is quite advanced politically. I know there are many issues still to solve, but the other cannot lag too far compared to that one. So the two have to emerge relatively in parallel. So the question of harmonization of deposit guarantee scheme is, I think, a little bit of lesser importance for the immediate future, can be dealt progressively, because very often they deal with idiosyncratic shock, but not with systemic shocks, I mean, basically. So the conclusion is, sorry, the banking sector is experiencing a necessary correction to overcome past excesses and to restore its health. The ECB's non-standard measures, I explained a lot of them, have prevented destructive, self-sustained dynamics. I think really we could do that, 5 or 6 episodes in the last 5 years, at least. They have also helped to address heterogeneity in the transmission mechanism of monetary policy across different euro area countries, although there are still problems. Most importantly, they have contributed to ensuring price stability. When we say that, it's really in the objective where risk, we say, are broadly balanced, but if these processes cannot be stopped, you can have downward risk on price stability, which was, I think, in the last and the previous introductory statement of the President in the press conference. And so going forward, a more integrated financial markets union is one of the top priorities in Europe, and the single supervisory mechanism is now, as you know, under construction. And thank you very much.